Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. After a wild, somewhat unexpected start to a new era of monetary policy, last week Fed officials broke their typical cone of silence leading up to the policy announcement with a plethora of commentary and differing opinions. Recall in September, the Fed opted to jumpstart its policy pivot with an outsized 50 basis point rate cut, a move the chairman himself called a strong start. However, the statement in the press conference offered somewhat of a more hawkish, a semi hawkish tone. As such, while the direction of travel has been clearly indicated, when it comes to the speed of adjustment or just how low rates will travel, the Fed is far from one mind. Atlanta Fed President Raphael Bostic, for example, underscored the motivation for that 50 basis point cut in September as a meaningful move towards neutral, as the risks between inflation and employment come into better balance. Bostic went on to warn, however, that policy is not on a predetermined pathway, and policymakers should not commit to a particular cadence of moves going forward, as uncertainty remains in the evolution of the data, as well as over where the so called neutral rate truly is. Echoing Bostic's call for a slower, more tempered pace of rate cuts, Minneapolis Fed President Neil Kashkari said he expects to lower rates by smaller 25 basis point increments going forward, unless, of course, the data change materially. On the flip side, taking a more aggressive and notably dovish position, Chicago Fed President Austin Goolsbee championed the Fed's latest outsize cut and said further aggressive action is warranted. In fact, Goolsbee said he sees many more rate cuts over the next year as interest rates need to be lowered significantly to protect the U.S. labor market and support the U.S. economy. Others, however, remain more concerned about still elevated inflation. Joining Stifel to speak at a Kentucky Bankers Association event last Tuesday, Fed Governor Michelle Bowman, for example, was clear that upside risks to inflation still remain. Bowman also commented on her dissenting vote in September, noting that in her view, a smaller cut would have better identified the strength in economic conditions while still making progress in a policy adjustment. Indeed, as we've noted before, the risk with a larger 50 basis point cut was always inadvertently sending an inappropriate signal of the Fed's intentions to rush back to provide support to the economy, as opposed to simply unwinding policy firming towards neutral as inflation moves closer to the target level. In fact, speaking of inflation, rounding out the August data, the market received a fresh read from the Fed's preferred measure of prices, the PCE. The headline PCE rose zero point 0.1 in August and 2.2% year over year, as expected, down from a 2.5% annual increase in July, and now marking the slowest pace of ascent since February of 21. Excluding food and energy costs, the core PCE also rose zero point 0.1 in August, a tenth of a percentage point less than expected, and following a larger 0.2% increase in July. On an annual basis, however, the core PC increased 2.7%, rising from a 2.6% annual gain in July and marking the largest annual increase in 3 months. Stripping out even more volatility and looking at the supercore, or core services excluding housing, the supercore rose zero point 0.2 in August and 3.3% year over year, also rising from the July pace of 3.2%. And with inflation showing less improvement than anticipated as of late, the latest read on the core PCE deflator was unrevised at a 2.8% gain in the second quarter, following a 3.7% increase January to March. Of course, while inflation has made less progress than anticipated relative to the Fed's or the market's forecast for that matter, the U.S. economy broadly continues to outperform longer run expectations, with ongoing positive growth in both the consumer and business investment. In fact, the strength and ongoing resilience of the consumer was in focus last week, with the latest look at income and consumption growth. Consumer spending rose zero point 0.2 in August and 5.2% on an annual basis. While nominally robust and rising from an average of 5% in the first quarter, this marks the smallest annual increase in 4 months. Income, meanwhile, rose zero point 0.2 in August and increased 5.6% annually, down from a 5.9% pace in July, and like spending, while nominally solid, the smallest pace of ascent since December. Turning to business investment, durable goods orders were somewhat disappointing last month, albeit stronger than the market consensus. Headline orders were unexpectedly flat in August, following a near 10% jump in July. According to the median forecast, durable goods orders were expected to drop over 2.5%. Despite the lack of upward momentum for the month, however, year-over-year headline orders rose 1.5% in August, the largest annual gain in 6 months. The bulk of the weakness was concentrated in transportation orders, down 0.8, following a near 35% increase the month prior. Thus, excluding transportation, durable goods orders rose 0.5 in August and increased 1% over the past 12 months, up from the 0.7% annual gain the month prior. Finally, capital goods orders, excluding aircraft and defense, a proxy for business investment, rose 0.2 in August, the strongest pace in 2 months. Year over year, however, business investment did decline, down 0.1, down from a 0.6% annual increase in July and the first annual decline since June. Taken together, the latest read on consumer and business activity supports the storyline of ongoing strength and resilience, exemplified in the latest Q2 GDP report. Second quarter GDP was unrevised at 3% in the final round report, as expected, and marking the largest gain now in 2 quarters. In the details, personal consumption was revised slightly lower, albeit still posting a solid 2.8% gain in the final report, and still marking the largest increase in 2 quarters. Gross private investment, meanwhile, a gauge of business spending, was revised up for a stronger gain of 8.3%, the largest quarterly increase since the third quarter of last year, reflecting in part an over 70 billion gain in inventories. Fixed investment, meanwhile, was revised down for a smaller gain of 2.3%, the weakest quarterly pace since the fourth quarter of 22, while non-residential investment, including office buildings and factories, was also revised down from a 4.6% increase to a lesser 3.9% gain. Finally, residential investment was revised down from a 2% decline to a larger 2.8% drop, marking the largest quarterly decline in more than a year. On the trade side, exports gained by 1%, while imports were revised up for a gain of 7.6%, the largest quarterly gain since early 22. Combined net trade was a sizable drag on growth, shaving almost a full percentage point from the headline. And excluding inventories, real final sales rose 1.9% in the second quarter after a 2.1% rise at the start of the year. And excluding inventories and trade, real final sales to domestic purchasers rose 2.8%, a 2-quarter high. Bottom line, a solid showing of domestic activity, at least in the rearview mirror, reinforces the need for a tempered and patient approach to subsequent rate reductions. With no indications of a downturn or mounting weakness ahead, despite modest cooling in some reads on the labor market, the focus should remain on returning prices to a sustainable 2% level. While normalizing conditions do warrant a less firm approach to policy and a continuation of rate reductions, a lack of meaningful ongoing disinflation supports a base case of smaller 25 basis point cuts, with a consideration but not a commitment to action at every upcoming meeting. As such, the next read on the labor market will act as an unusually large driver of the Fed's move come November and at year end. That being said, any further signs of cooling or a loss of momentum from earlier peak levels of activity, coupled with ongoing uncertainty in terms of the future pathway of growth and policy, particularly amid the upcoming November election, this is all seemingly beginning to weigh on consumers. Last week, the latest read on consumer confidence showed a material erosion, with the headline declining nearly 7 points to a read of 98.7 in September, the largest drop since August of 21 and a 5-month low. In the details of the report, a gauge of current conditions decreased by over 10 points to the lowest reading since March of 21, and a gauge of future expectations declined by over 4.5 points to a 2-month low. This week, the economic calendar begins today with the Dallas Fed Manufacturing Activity Index, along with the Chicago PMI. On Tuesday, the final S&P Global U.S. Manufacturing PMI is released, along with construction spending, the JOLTS report, or the Job Openings and Labor Turnover Survey for August, and the ISM Manufacturing Index for September. In August, manufacturing activity rose a minimal 0.4 of a percentage point to a reading of 47.2. Despite the monthly uptick, however, this marks the 5th consecutive month in contractionary territory, or a reading below 50. In September, the ISM Manufacturing Index is expected to rise, albeit still remain in contractionary territory, at a potential reading of 47.7. Also tomorrow, total vehicle sales, and turning to Wednesday, we begin with weekly mortgage applications, followed by the September ADP employment report, and later in the week on Thursday, weekly jobless claims, the final September print of the S&P Global U.S. Services and Composite PMIs, along with factory orders for August, durable goods orders, and the ISM Services Index, also for August. Like the manufacturing ISM, the ISM Services Index unexpectedly ticked up in August, albeit minimally by 1/10 of a percentage point to a reading of 51.5, the highest reading since May. This month, the Services Index is expected to remain unchanged at that reading of 51.5 in September for the second consecutive month. And on Friday, we come to the key release of the week, the September non-farm payrolls report. After a smaller than expected gain of 142 in August, non-farm payrolls are expected to rise a smaller 130,000 in September, potentially marking a 2-month low. Although the gain would potentially boost the 3-month average from 116 to 120, a 2-month high. The unemployment rate, meanwhile, is expected to remain steady at 4.2% for the second consecutive month, still well below what the Fed designates as the full employment range, and perpetuating the notion of ongoing tight-ish labor market conditions. And average hourly earnings are expected to rise 0.3 in September, following a larger 0.4% gain in August, resulting in a 3.7% increase over the past 12 months, a potential decline from the 3.8% annual increase in August. With a growing focus on potential weakness in the labor market, a weaker than expected read in Friday's report will no doubt boost expectations for a more sizable Fed response come November. Equally, however, further indications of an ongoing solid or steady labor market, coupled with still elevated prices, will serve to underscore the need for a more tempered and patient approach to rate cuts going forward. And finally, on the FedSpeak front, we will again hear from a number of Fed officials this week, including Chair Powell himself later today, Bostic and Cook tomorrow, and Cleveland's Beth Hammack, who took the place of Loretta Mester last month. Also this week on Wednesday, St. Louis Fed President Alberto Mussolem, along with Governor Bowman. And finally, on Thursday, we'll hear from Minneapolis Fed President Neel Kashkari. Already, the array of Fed chatter throughout last week and mixed messaging is further muddying the waters, underscoring the uncertainty in the Fed's pathway forward and the lack of consensus among officials as the data continue to evolve. And with that, I'd like to thank you for starting your week with Stifel.